Hello and Happy New Year. This is the first show of 2023. It is amazing that we're already rolling and it's already been just about a week until we got into in this new year, which is amazing. But I hope you all had a great holiday season and hoping you all have a very healthy, happy, peaceful, and, because I'm the financial chick, prosperous new year. So we're going to talk a little bit about some exciting stuff that's happening. You know, the good, the bad. There's not a lot of ugly, but we'll kind of talk about all of it. So I want to thank you for tuning in today to the Financial Chick Show. I am Denise Nostrom, the CEO and owner of Diversified Financial Solutions, a full-service independent financial planning firm located in Medford. I'm here live every Friday from 5:30 p.m. to 6 p.m. on 103.9 LI News Radio. Your Financial Chick is here to help you make better financial decisions and choices to improve your life and reduce your anxiety and stress about money. If you have any questions on anything we discuss here on the air, check out my website at financialchickshow.com or call my office at 631-758-8691. You can also find us on Facebook and Instagram at Diversified Financial Solutions. So one thing too that we're going to institute for the new year, again, new year, new me, new you. It's a brand new start. Not that we like flipped a switch on New Year's Eve that to make it all better. I think I talked about that the day before New Year's Eve. But you know, we have to go in optimistic and positive and hope that things are going to be good. So what we're going to institute for the new year is the last Friday of the month. We're going to open it up to you, the callers, to call in. So think of your questions and call in and talk to me, the Financial Chick, to get answers about all of your financial questions or insurance. Or really, I mean, I don't want to say anything, but we can chat. I mean, it's all good. So that's going to be rolled out the last Friday of every month is going to be Phone In Friday. So I'm pretty excited about that new endeavor that we're going to do. So where do I start otherwise? Well, what happened today? You know, the market started off with a real roller coaster of a week so far in 2023. The good news is that we had a great day today, and the stock market is up for the year. Now I know that's not really an super exciting thing because it's only been less than a week, right? It's still early, but you know what? It feels good when I can share some positive news. So we asked the question, you know, people say, well, why is it up? Why is it down? Why are things like that? So the reason it was up today is the job numbers. The job numbers came in better than expected. So what happens is the powers that be put out estimates as to what things are going to be. And if they do better, people feel good. If they put out an estimate and it goes below the estimate, people don't feel so good. So the job numbers, like I said, were better than expected. And this was for the month of December. So that's kind of, you know, it's not really a big shocker because the month of December, what happens? Well, a lot of the stores, a lot of the restaurants, you know, they know they're going to have a higher volume due to the holiday season shopping, or, you know, people are just getting out there doing things. So they hire more people. And then unfortunately, January comes, and what do? They kind of get rid of people that they don't need because the volume is not there. January and February tend to be sleeper months, especially in retail and that type of thing. So, you know, December, usually a good month. So what's another month that's usually good? If you had to think about this, I actually have an intern in my office right now, and we had these conversations today. And she kind of knew, she didn't know the month, but she kind of had the idea. And the idea was, yes, June. June is another good month typically. And why is that? Because school is stopping. You know, so kids are working a little bit more, maybe high school students, and even more so college students. They're taking on jobs, so the job numbers tend to increase and do better at that point. So yeah, so bad numbers we usually see January, and then of course in September, and that's when everybody gets back to school and college and all of that. So these trends are good, and they're our friend, and we enjoy them, but you know, sometimes there is a deeper reason why. So we get excited because we want to feel good, but you know, sometimes it's good, but it's just not the end all be all. So I'm going to start off like where we were and where we were from 2020 through 2022. So I kind of, you know, I'm always like nostalgic with things, and so I pulled up some numbers at year end to see what was going on. So I take a look at the various indexes or indices that we compare our investments to. So we look at the S&P 500, the Dow Jones, NASDAQ, we have foreign or international stocks and emerging markets. Now in 2020, all of those indexes ended in the green or positively. S&P up 18, Dow Jones 9.7, NASDAQ 44.9. Now, if we relate that to 2021, which was also a really good year, we had the S&P up 28%, the Dow Jones up 20, the NASDAQ 22. So again, very positive, things were good. And then of course 2022 came, and we just closed out 2022 on Friday, and the numbers look quite different. So for 12/30/2022, S&P off or down 18.3, the Dow Jones down 7%, the NASDAQ down 32.9, the Russell 2000, which was a new entry this past 2 years, down 20.6. Those are the small companies. International stocks down 14 and emerging markets down 19. So a big change from 2020 to 2022. And like I said, 2021 being the kind of the changing year. It was a good year, but we started to see when things change, and then 2022 just kind of really fell off the edge. So we also take a look at the various equity sectors in the S&P 500. So in 2020, we had information technology running up, the top, consumer discretionary, again, things we don't really need but we like to buy, whether it be designer handbags, hot tubs, pools, things we really don't need but we like to have. Boats could be another one. Communication services, those rounded out the top three. We went to 2021, and then we saw a bit of a difference. So we had information technology, consumer discretionary, communication services. Then we went to the best performers, energy, 2021, real estate, and financials. Big change there. I mean, we didn't see any of the names from 2020. Then we jumped to 2022, and the whole story there was energy continued to stay top of the heap, followed by utilities and consumer staples. So people are, moving away from the technology sectors, the exciting stuff, and moving more to the more, I don't want to say conservative, but more of the tried and true, your company's consumer staples, your Procter & Gamble's, Clorox, etc. What's very interesting is that the top three of 2020 are actually, in 2022, were the bottom three. Communication services down 39.9%, consumer discretionary down 37% last year, and information technology down 28.2%. So you can see the change is crazy, and the roller coaster is apparent. But what's really, really interesting in looking at interpreting the numbers, let's take a look at the S&P 500. It ended or it closed in 2020, December of 2020, at 3756. In 2021, it bounced up to 4766. And then in 2022, we just ended off at 3840. Now, why do I say this? Well, we were 3756, and then we closed up at 3840. So from 2020 to 2022, the Dow Jones, the S&P 500 actually was up. And if you would say that, if you're looking at your statements that are going to be coming in very soon, you wouldn't believe that. But we had such a great year last year, we kind of gave back some of the return that we had. So this is what I tell people, look more for the long term. If you go year by year, it's a roller coaster. If your goals are long term, this stuff works and you want to stick with it. But throwing in some other things, let's take a look at some other. The Fed funds target rate, which indicates what interest rates are, was 0.25 in the end of 2020. Was still 0.25 in 2021. Now, what looked different? 2022, the Fed funds target rate 4.5%. Now, that of course is going to really, really change a lot of things, when you're borrowing money or whatever it is that you need to do. Inflation, 1.6% at the end of 2020. 2021, 4.9%. And then in 2022, 6.6%. And that's only the core CPI, so that doesn't tell the whole story. So, the bottom line is that, it's going to be tough. You're going to be getting your statements. They're not going to look superb, but it doesn't mean that if you've been in the market for a while that all is lost. So you're listening to the Financial Chick Show, and I am the Financial Chick. I'm here to help you navigate the financial waters to make the right decisions, especially in this crazy market environment with inflation and recession and everything else that's on the docket. But we're going to talk a little bit about those things, and like I said, there's good and bad, but there's a lot of good that's come out of this, so I call them the green shoots. We have a lot of things that we can take advantage of. So stay around and catch me after the break. Got a little tongue-tied. Welcome back. This is Denise Nostrom, the Financial Chick. My company is in Medford, and you can reach me at 631-758-8691 or visit my website at financialchickshow.com. I'm here to help you on your financial journey. Over the years, things change, and I'm here to help you navigate all those changes. So we are talking about some strategies and looking back a little bit to look forward the new year and see what is going on. I see some good things here. Well, I don't know what just landed. I'm at the airport and people are milling around, which is nice to see. I don't know if it's Frontier or Southwest, but hopefully Southwest's got their acts together. I think they're doing a little bit better, so that's a good thing. But before the break, we were talking about what's going on. I mean, the biggest concerns that people have right now is obviously inflation, the possibility of a recession, and all these things are prevalent. But then today we got the employment numbers, and they came out really well, and there was more people getting jobs in the month of December, which we talked a little bit about, but it's good news, and the market definitely liked it a lot. It was up over 2%, the Dow Jones, and up over 700 points. So pretty good start to the year. Again, it's not the end all be all. It doesn't mean that that's what's going to happen the entire year, but it's still good to kind of see something positive early in the year. So, inflation obviously is still an issue. Inflation this past year has exceeded 7.5%. Although it started to slow, in the recent months. I mean, it was close to 9 or 10% at some point during 2022. And there's many factors that contributed to it. Supply chain issues, to the war in Ukraine. They've definitely helped to spur inflation. And of course, the high cost of energy has definitely been an issue. And it's been crazy. So the Federal Reserve thinks that the best way to combat this inflation is to raise rates, and that's what they've been doing. And we'll see. I mean, hopefully they're going to be laying off the gas pedal a little bit, just to see how it's going to go into the system. Because, like we talked about, we went from a 0.25 Fed funds target rate up to 4.5. So what does that mean to you? Well, I happen to be at the bank this week, and I never really go to the bank. I usually do everything, via the internet and put my checks in and all that kind of stuff. But I had to do some business at the bank. So it was very interesting to see some numbers, and this is the enormity of the interest rate increases and how it's going to affect you and I every day and in the future. So the first thing was kind of harrowing. They had something that said a holiday loan. You can take a holiday loan, meaning that you spent way too much more money that you didn't have. Although it's probably better than the credit card rates that you have. They're anywhere upwards of 15 to 20%. But there was a holiday loan for 6.84%. So when you think about that, they're still giving us about 0.1 on our savings account, but we have to pay them 6.84% to borrow money to help ourselves. So it's too late. We can't look in the rearview mirror. Obviously, if you spend too much, but that's something that you really want to take care of, is paying off that debt. One thing I thought was very interesting too. So CDs are all the craze now, but it was very interesting. Now, I don't know if I put this sign up, but the CD for 16 months was 4.25. Not too bad, right? I mean, because compared to what we had, it's awesome. But the same rate, 4.25, was for a 60-month CD, which is 5 years. So you have 16 months, a little over a year, versus a 60-month. I mean, I don't know. I mean, I guess there's positives for either one, but I just thought that was very interesting, and it kind of hit me, and I just thought it was wild. So home equity lines of credit. I mean, many people were taking them when the interest rates were low. I know I had a special rate when I took ours. It was like 1.5%. Right now, the introductory rate is 5.75, and then after that introductory rate, which is typically like 18 months, it's a 7.5% rate. So we're talking big numbers here, and you just want to really watch your debt and make sure you're not spending more than you need to, especially with inflation raging and everything costing more. Heads of lettuce, $6, it's just insane. So we do have some good news. It's kind of like you take a look at things, and when I went to college, I was in a co-ed fraternity, and we'd say in the business that I can't say the word on the air, but it's basically F them before they F you, which is really like, you don't want to do this in a bad way, but I'm talking this from a standpoint of a financial advisor and helping you with regard to your taxes and saving and doing the best things. So there's stuff in the tax laws where there's different things that the government allows you to do, and if you don't know about it, you're missing out. So I'm going to show you a few things that you don't want to miss out this year. So one of the things is that new IRS tax brackets are taking effect this year in 2023, means that your paycheck could be that much bigger. So what they did was the standard deduction's a little bit higher, but they also have higher income tax limits. So which means whatever tax bracket that you were last year, when you get your paycheck, you're going to actually see a little bit more money in your paycheck because they've shifted the numbers. And the reason they did that, not because they're nice and they want to be nice to us, is because inflation's so high and they know things are tough. So this is a way that in that $1.7 trillion bill that was passed, that they were able to kind of give back, I guess. It's really not giving back, but at least it helps. And again, you want to take the things that, are coming to us, and obviously that are legal, and things that we can do. So that was one really big deal that came through this week. Another thing that came through, which I thought was really amazing, and this is not going to affect all of you, but 529 plans. So some of you have it, you save money for your kids. Some of you blow through it really quickly because you didn't put enough money in, and college is super, super expensive. But some of you have this fact, or some of you don't start a 529 for your kids for college education because you feel that, what if they don't go to college? What if I don't use it? Or what if I save too much? And I actually just I have a client this week that has this situation that, the kids fortunately got scholarships and they did save a lot, and they're probably going to have some money left over. So one of the nice little things that came out of this $1.7 trillion bill is that if you have money left over in your 529, you can take that money up to $35,000 and you can roll it into a Roth IRA for the beneficiary. This is a huge deal because, again, if it's like if you don't use it, you lose it. Here, that's not the case anymore. And it's a really good strategy. Again, it's a new strategy. If you have questions, call my office. Go to my website, come in for a complimentary consultation, but this is going to be a really, really big deal. You can actually put money away for your college education for your kid or kids, and you can save this money tax-free. And if in fact you don't use it all, you can actually up to $35,000 put it into a retirement account. And there's a way that you can change beneficiaries. Like I said, I can be very creative, legally of course, but creative to kind of help you navigate these new tax laws and new things to really make it beneficial for you. So talk to me about that. That's a really big deal. One thing that also changed, and again, it's not going to affect all of you, but some of you, is that the government has changed the RMD age. Now, if you recall, prior to 2020, it was 70 and a half, that good old magical 70 and a half. They got a little smart and they did change it and they made it 72, which was a nice even number. But now they changed it again, so starting January 1, you do not have to take RMDs now until you're age 73. So if you're 72 this year, you can forego and you can wait another year before you have to start taking that money out and be taxed on it. So, it's a bright side because, like if you don't need to take the money out because you adequately have enough money, it's a bonus. Like you can kind of push it ahead. If you are taking the money because you don't have a pension and stuff like that, it really probably will not affect you because you might take it a little bit earlier. But it's a really, again, I think it's a good thing. And one of the things, while we're talking about RMDs, because the market was pretty tough last year and the market didn't do so well, your RMDs compared to what you were taking in 2022 are probably going to be a bit less. So just be cautious of that and, speak to myself or your advisor. If you need that money to live on, you may want to adjust it if you're doing automatic RMD payments. So there's a lot going on. Like I said, there are some green shoots that are coming up. We're hearing all the negative stuff, but I'm here to tell you that there are some positive things. So give the office a call, find out what's pertinent to you and what you could take advantage of. And, it's just, basically, I guess, F them before they F you. No, that's a terrible thing to say, but again, you know what I'm saying. So I just want to thank you for tuning in today. You were listening to the Financial Chick Show, and I want to thank Anthony, my engineer, and my program manager, David Levenstein. Thank you, guys. And I just want to say that I'm excited. I'm excited for 2023. We had quite a year in 2022, so I'm ready for some good stuff. So let's do this. Let's all do better and be better, and I'll see you next Friday. All right, it's a wrap. See you next week.